Welcome back. We've also got Nitin Jain joining us this afternoon. Nitin, Nifty just about coming back into the green right now, but it's been a pretty choppy session to say the least, and markets seem to be really unforgiving of any stock that is disappointing them today, or at least for the last few sessions. Where are we headed, Nitin?
See, I think looking at Nifty at least today does not give the true picture of what's happening in the markets. If you look at the broader markets, I think except for few stocks, I think most of the mid caps and a lot of stocks which are leveraged, I think the way they're getting hammered, it looks like it's the end of the world or something. And I think that's been a trend for some time now. And I think investors would be doing themselves a favor if they start looking beyond Nifty, because if you remove ITC, HUL, maybe a couple of banks, I think markets are in a very bad shape. And I don't see that changing in a hurry, though it also means that you will get some trading opportunities for a bounce back. So if you're looking for from a 2 to 3 day kind of a horizon, you can buy some of these very oversold stocks. But I would not recommend buying at these levels, at least from a medium term horizon.
Let's talk about the damage that's going on, Nitin. Your point is very well taken. I mean, just look at stocks. There's a Punj Lloyd which is down 10%, IRB is crashing 24-25%. Financial stocks like PFC, all your mid-cap PSU banks, every day they get hammered 6-7-8%. On the financials specifically, what is it that you're advising now?
No, actually it's very interesting that at least till a couple of weeks back, before the RBI action happened, we were generally very bullish on the private sector banks and some of the retail NBFCs. I still maintain my stance on some of the retail NBFCs, but the fact remains that what has happened in the last couple of weeks is unprecedented. Today the yield curve has actually become inverted, which means that the short-term rates are actually much higher than the long-term rates. And this is terrible news for any financial services organization, particularly banks. And hence you're seeing the carnage across the space, whether it's IndusInd Bank, whether it is Yes Bank. And then when you look at some of these PFCs and some of the other state-backed organizations, then there are other issues of NPAs and all. So I think overall the sentiment is quite sad. And more importantly, as long as you see this inverted yield curve, you will see most of these stocks who generally borrow on the short end of the curve, I think getting hammered quite a lot.
So what's the advice now? Stay away from PSU. What about private sector banks? Because even they have fallen a lot in the last couple of days. Would you advise bargain hunting?
As I said earlier, I think if you're looking for a short-term bounce, I think it's very likely, maybe in a Yes Bank, maybe in a ICICI Bank, maybe in IndusInd. I think you can see 5, 10, 15% kind of a bounce from these levels in the immediate future. But as long as the fundamentals on the ground do not change, I would be cautious to get into these stocks from an investment point of view.
Okay. All right, so that's the call coming in there. Nitin, just to take a quick check on an idea, numbers expected later today. If you've been tracking it, any expectations there?
No, actually I don't track idea as a stock.
All right, so not looking at idea. And Bharti, of course, yesterday did positively surprise on the operational front. What's your outlook on a Bharti?
So, I think some of these telecom stocks overall, I think are very high quality organizations. I think a lot of negative news flow has already got factored into these stocks. Hence, I think there are some good trading opportunities that keep on coming in these stocks. And if you look at a 3 to 5 month kind of a horizon, I think some of these stocks actually present good bets. Technically also they are looking reasonably strong. So it can be a good trading bet. But if you say, can this sector create serious value over the next 3-5 years, I doubt that very much. For me, I think telecom story is mostly played out. And hence, purely as a trader, I might take some positions there, but not really as an investor.
All right. Nitin, let's moving back to banking now. We've got Union Bank of India that also was out with numbers. It came in slightly below estimates. Bad loans have risen 12% for the bank. Debrata Sarkar, the CMD, is joining us on the show. Mr. Sarkar, profits have been weaker than analysts estimated. NPAs have risen. Just take us through, some of the factors that have been at play this last quarter.
No, the profit has not. We had the increase the profit in comparison with the last quarter of June 2012. But as you know that we could not increase the credit pickup is not there. So naturally the earnings under the pressure, and because of asset quality deteriorated, I already covered in general that okay, it is because of in the expected line. But my credit assets has not increased, rather decreased over the March. Secondly, some two big lumpy accounts have been converted into NPA. So that is the main purpose of this, because there is some reversal of the interest also in respect of the income. So taking all this together, basically the profit, though it is about 10% increase in the last quarter of 2012 June, but had not been the reversal was there or not this two accounts really slid back, I think we could have been better positions. That is the main reason for our this situation.
Right, gross NPAs have also risen after showing a decline for the last 3 quarters. So what's the outlook on that front? Can they return back to a 3%?
Now, I never, apprehend of the up move. Please excuse for it, because, if you see the last 3 quarters till March 2013, consecutively 3 quarters we could reduce. The highest peak was at 3.76% in June 12. So consecutively, the Union Bank has reduced the gross NPA as well as net NPA. But after March, as I told that, okay, the first quarter is always subdued in respect to the credit demand, and whatever we have given the guidance in respect to the slippage, about 700-800 crores, that we could maintain this same level. But because of the two accounts slid back, with the lumpy accounts about 600 plus, that is the reasons for the asset quality deteriorated over March. But we are hopeful that, okay, is always try to maintain below 3%. That attempt will be there from our side.
Sir, can you take us through the margin picture, given the fact that, we are seeing tightness now creep back in the short end of the money market rates, and also what that will do to your bond portfolio and the mark-to-market hits that you'll have to take?
Restructuring, we have given the estimate earlier that it should be around 2,200 plus minus little bit, but in this quarter. But it is, I can tell you that it has not come that much, the restructure's proposal. So our restructure was 1,068 crores. So in that case, we expected that 2 ACBs will be coming because of the bilateral restructuring took place earlier. But after that, the government has come with the new guidelines that 50% will be in the form of the government bonds, especially the state government bond. So maybe that's 2 or 3 may be coming in this quarter. So pipeline taking this carryover, it should be around 5,000 crores. It should not exceed. Taking this about 2,500, 2,600 in the ACBs. So more or less in the expected line, and especially the sectors are the infra sector, maybe in the power sector, maybe in textile. These are the few sectors. So it is not a big apprehension, because after this government has taken the restructures, for all the ACBs at par. I think that is the only issue, that whether they are coming this quarter, and that is I am telling about the July to September quarter, that it will be hovering around 5,000 crores.
Okay, all right, sir. What about margins then? Are you expecting further compression given the way the money markets are behaving, and also with bond yields spiking up? What's the MTM hit that we're talking about?
The margin pressure came, that is presently 2.63%. Certainly it was 3.01% that time. And what basically happened, that somehow the reversal took place in respect of the interest earning. Cost of deposits, though it is marginally reduced, but the low cost deposits are not coming to the banking system, and we are also the same experience. And at the same time, we have reduced our base rate in the month of February. The full effect came in this quarter also. So in that case, taking all together, the interest earnings really under pressure, and at the same time, we really did not succeed in respect of the reducing the cost of deposits substantially. And as I told that with the reversal and all these 3-4 factors, it is under pressure. But again, I am telling that it is because of the some reversal in this quarter, it may not happen in the next quarter. So whatever the guidance we are giving earlier also, that okay, we will try to maintain at 2.9% level, that still we are maintaining, that we will try to maintain at that level. And in respect of the bond, how it really, especially the short-term positions or the short-term bond market as such, and the banking industry is suffering for it. We hope that okay, the bond market should improve. But at this moment, I am not calculating any MTM losses as a concluding figures. Let us see what happens. I think we are expecting that the measures are temporary, and maybe that after a few days it will improve.
Right, now post the RBI's measures, yesterday both Axis Bank and Yes Bank hiked rates. Today Punjab National Bank also hiked FCNR rates. What can we expect from Union Bank?
Now in that case, the base rate we have already reduced to 10% on 8th of July this year. And we did not tinker any cost of deposits rate, especially I am telling about the term deposits as such. So we have to take a call. Just let us see. As I told that, okay, low cost deposits are not coming, and if the market is like this, that okay, the flows deposits is under stress, then we can think over, but not immediately. Just we'll watch for another few days, and then we'll take a call whether to increase or not. So it is not the question of following the other banks and going just to increase the rate of cost of deposits at this moment. Let us see what the flow is coming. And as I told earlier also that okay, the composition of the deposits are differing from bank to bank. We have reduced the high cost deposits substantially. Presently it is below 8% against government expectations not going beyond 15%. So more than 50% we have reduced still. CD we are not really looking at this moment. So we hope that okay, some benefit will be getting out of it, and we'll take a call after just watching a few days the behavior of deposits coming to the bank or not.
Right. How do you see the recent tightening affect advances? Will you relook at projections for the year?
Now that full year, whatever the guidance we have given earlier, that we are looking at a 15 to 16% advance growth, we are hopeful that we will be achieving this target.
Thank you so much for joining us and taking us through that, Mr. Sarkar. It's Union Bank for you. Markets a little disappointed with those numbers. Hemang Jani is also joining us on the show this afternoon. Hemang, banking stocks continue to be hammered with all those concerns around asset quality. What are you doing with banking stocks at the moment?
Well, clearly the sentiment is negative towards banking stocks, though we are seeing some pullback in select names like Axis Bank and HDFC Bank and a couple of others. But there is a greater uncertainty about how long this interest rates, at least in the short run, will remain at a higher level. More importantly, the way the NPL cycle is turning, there is a fear that over the next probably 1 or 2 quarters, you might see some more names coming under the clout of the higher interest rates, particularly companies with a huge debt. So there is an incremental risk which is there for the banking system, and which is why we think that the overall bias towards the banking stocks, particularly PSU banking stocks, would remain negative.
Right, Hemang, also give us a call on markets right now, given the kind of battering we've been seeing over the last few sessions. What is your sense on valuations and how much further you see us heading downwards?
Well, if you look at the market, the overall earnings growth that most of the people are expecting for the next year is about 7-8%, and we are quoting at about 13.5-14 times. But given the risk of the earnings downgrade over the next let's say 1 or 2 quarters, we think that people are not going to be focusing on the valuation. I think what people are focusing right now is that the overall rupee stability is not going to be achieved by whatever RBI is doing, and given the kind of hole that we are seeing in our current account deficit, the rupee, the bias is definitely going to be on the downward, and that will mean that the flows are going to be pretty muted. Also, this interest rate part is also playing a spoil sport. So I think that the feel is that probably you will see another correction of about 8 to 10% in the market over the probably next 3 or 4 weeks time.
Hemang, what about some of the infrastructure stocks? Take a look at an IRB today. The kind of cut on that stock is outstanding, 20%. Yes, they've drawn out of a certain project, but 20%, and we've got lots of other stocks there too from that pack that are seeing a bit of a hit today. What's your call on some of these infrastructure names at the moment?
Clearly, this is a space which is going through that stress of the high debt, and some of the projects could get stalled or cancelled, and we think that at least in the near term, though the fall is quite steep, the sector would remain under pressure, because we think that something like even L&T, if you look at their performance, it's quite muted, the margin pressure is there, and the overall execution speed is pretty low. So we think that it's better to stay away from this space.
Hemang, I'm just seeing the market screen right now, and there's some buying that's come back to Lever and ITC. Both these stocks are holding up, but the debate is pretty wide ranging. We've seen numbers from Titan. Again, they're also talking about weakening consumer sentiment. What are you advising on both sides, the staples side and the discretionary side of consumption?
Well, see, if you look at the numbers, HUL numbers were clearly not up to the mark. The stock has run up post the open offer, and where we feel that there are more technical factors at play rather than the fundamentals of valuation. We think that the next couple of quarters for the consumption theme are not going to be that good. The volume growth is going to be below 5%, which is not a great news. So there might be a technical pullback, but I don't see a great upside potential in HUL. ITC, yes, numbers were okay, but we think that the stock should stabilize around current levels.
Right. What about the oil and gas pack, Hemang? Let's take a look there. I mean, the kind of correction we're seeing there is also worth taking a look at. RIL is down 2.5%. BPCL continues to be down about 6% right now. We've been seeing those cuts coming in thick and sharp. ONGC is also down about 5%. What's your call there?
See, upstream companies like ONGC, Reliance and Oil India, there is definitely a feel that since you will have a slightly better realization on the gas price front, there is definitely going to be a little better visibility on the earnings front. But the downstream companies like HP, BP, IOC, we think that both the rupee as well as the crude price movement and the fact that some of the companies are going to be coming up for divestment means that there is going to be a further value destruction. So we think that it makes sense to confine to something like a Reliance, ONGC and Oil India.
All right, Hemang, we'll leave it on that note. Thanks for joining in today. It's a call coming in from Sher Khan. UBS is making some comments on what's just come out from the RBI website. UBS says RBI forex hedging rule to have a stronger impact on the NDF market. RBI rule on FII hedging aims to curb speculation in the rupee. The RBI has basically gone ahead and said that all FIIs must take permission from participatory note holders who wish to hedge their India exposure. So we'll try and get you some more analysis going on this, but it's definitely helped the currency to an extent. It's pulled back from the lows that we were looking at till just about half an hour ago or so. So we're looking at a 60.47 on the screen right now. We're going to try and come back and get you some more clarity on this in just a bit.
Countdown, presented by BSC, Investors Protection Fund. Protection Fund.
14 minutes to go. Let's quickly run you through what's making headlines this Thursday on the street, the factors at play. Jittery day for the markets as concerns from NSCL spill over to the equity bourses. The volatility index spikes over 6%. The Nifty registers an intraday swing of over 120 points. The financial technology stock continues to trade lower, down 64%. This after the National Spot Exchange suspends trading of all one-day forward contracts. SEBI orders a probe into the stock crash. Rate sensitives and oil and gas stocks remain under pressure. JP Associates is down 10%. Reliance and ONGC also hit hard. And no respite on the asset quality front for PSU banks. BOB posts a rise in bad loans. However, private sector banking stocks stage a recovery intraday. Alright, so there's this latest ruling that's come in from the Reserve Bank of India that's obviously playing itself out right now in the markets. We don't have too many details on it, but basically in gist, what the Reserve Bank is saying is that for foreign investors who do issue participatory notes, and if those P-note holders want to come in and hedge their India exposure, there would be some kind of a permission that is required. It seems UBS is of the opinion that this will curb volatility in the overseas market, in the NDF markets, and that's exactly what we were in fact discussing with our morning rupee guest, Mr. K. And they saying that somehow you have to control the NDF market. It's the NDF market which gives a cue to the spot opening of the currency here. Until the time the rupee is weak in that NDF territory, we continue to see weaker quotes here as well. So UBS, just to quickly reiterate what they've said, is that the RBI rule on FII hedging would be curbing this speculation, and they say that the rule will have a stronger impact on the NDF market, will deter short positions on the rupee. in the near term. So this is what we've got. Some quick comments coming in there on the RBI's latest salvo in order to try and protect the currency and prevent excessive speculation on it. That's the UBS reading of the situation. But is it getting any better, and are all these efforts adding up to much? Well, earlier I was in conversation with Andrew Holland of Ambit Investment Advisory on what he thinks of the current situation.
So our strategy hasn't, boringly hasn't changed. We kept with our defensives. In this month, what happens in reporting season, you get the first part of it's not so bad, which it was exactly the same here. And then as we come towards the end, you start to see the real problem companies with there. So it's always been a great area to kind of short those companies as they rise with the start of the earnings season. Obviously, banks has been a great sector to be short of. And continues to be. I mean, you might get a bounce from here just because we've fallen so sharply, but to be honest, I think everyone will use this opportunity to add more shorts in there. So we'll keep to defensives. I think over the course of August, we'll be looking very closely at the banking sector again for the value.
Okay.
And that includes PSU banks. I mean, at 0.3 times, some of them, it's value. I just don't know how far they're going to, if that 0.3 is really 0.5, because they've got actually a lot more problems than we're thinking about. So I think there's more downside for the banking sector in the short term, but that's the opportunity. So I've been talking about when do you make that switch from defensives to interest rate sensitives. It's soon. It's coming. Because
so
I think
this last downfall is perhaps what is going to be the last round of the carnage.
Yeah, maybe the crisis will just throw us all into that panic. And I go back to, I remember in the UK when when Soros made all his money, they defended the currency by increasing interest rates throughout, and then abandoned it, and that was the start of the new bull market for the UK.
Oh, well, who knows if we're in for something similar. You mentioned consumer stocks, and this earnings season I've once again heard lots of question marks being raised, volume growth, and is it justified to buy lever at 700, etc. Of course, it's come off from that, and again, question marks on ITC strategy, etc. So what about these consumer stocks? Because again, they're so heavily owned and the multiples are so high, room for error probably is limited.
Yeah, I mean, the problem is that if you've taken that view, you've massively underperformed. Because Unilever going from 600 to 700 was a killer for you in terms of not holding a good weightage.
Whoever tendered ended up feeling like a bit of a fool, but
yeah, whatever. But I mean, you just underperformed, and now you've got to try and get back that performance. Where are you going to get it from? If you're saying that these valuations are stretched, then you're not really expecting them to move up so much.
But is the volume growth a bit of a concern for you? Do you think that's, or is it only justified looking at the overall environment? There would be a bit of a cool off.
Of course, I mean, but again, it's relatively compared to some of the results we're seeing, it's a safe haven, and that's all you need to think about. So we've continued with our consumer stocks, we've continued with pharma, and we've continued with IT.
That's Andrew Holland with his view on the markets. We've got Nitin Jain also still with us. Nitin, also specifically just bringing up the JP Group for a moment. Look at the kind of cuts we've been seeing there of late. JP Associates itself has been down about 10%. If you've been tracking that movement, what's your call there on some of those stocks?
See, I think looking at stock prices for some of these stocks, I don't know whether that's the right way of evaluating how much value erosion is happening. Because, most companies you have to see from a point of view of what is the kind of enterprise value that they're trading at. And what has happened is over the last 3-4 years, most of these companies actually have garnered so much debt on their books that they're trading at 9 to 10 times in terms of debt vis-a-vis the market cap. And hence, I think most of these companies have actually become like call options. For an equity holder, now it's basically whether these companies will survive, and if these companies survive, I think you will see a multi-bagger coming out of these stocks. But if the companies don't do well, if the companies are not able to service their debt to the levels that they have raised, I think you can easily see even further 30-40% kind of a erosion in these stocks. So these stocks have actually become very, very high risk from that perspective, and I would like to kind of avoid, at least from a more conservative kind of an investor's point of view.
Okay, let's take a look at the few stocks that are still standing strong in the market today. Of course, one of them, and we were talking about this earlier, is of course HUL, which is seeing a strong gain coming in of about 4%. Axis Bank is also up about 5% right now, as is an HDFC Bank. So some of these banks are bucking the trend today. But when it comes to these movers, Nitin, and HUL or an Axis specifically, your call?
I think it would be quite different for HUL and Axis Bank. I think HUL, everybody has been very surprised by the move. I think after the open offer, the expectation was that the stock will settle closer to 500, and the stock surprised everybody. And largely the reason for that is that everybody who wanted to get out of the stock actually got out. Now if you think about it, there are hardly any big sellers left in the stock. There's very limited float that is available, and hence I think the stock is going to surprise even further for the next few months. My suspicion is it would stay above 600 for some time to come, and hence I would definitely have a long bias on this stock. On Axis Bank, as I was talking earlier also, I think it provides great opportunity from a immediate bounce point of view. The stock is terribly oversold, and whenever stocks get so oversold, I think they tend to react also very sharply. I think 8 to 10% move in these stocks cannot be written off. And hence, purely as a trader, I think you would want to go along these stocks with reasonable tight stop losses. But from a medium-term point of view, again, I am not very sure that the worst is over for banking industry, and hence I would be very cautious.
Nitin, so what's the broader advice out there? Are you expecting a much bigger or deeper crack on the index per se? I totally get your point about the pain overall in the broad market, but do you expect an adjustment on the index as well?
I don't know what is a deep cut, but another 5 to 10% possibly on Nifty can't be ruled out. But as I said earlier also, I think the market has become very, very selective. Any company that is leveraged a lot more or is dependent on capital for further expansion, I think these are the companies that are getting hammered a lot. All the consumption stocks, pharma, IT, I think continue to do well, and I think in some manners even rupee helps their cause, and hence I think this divergence will continue, but I think 5 to 10% downside can't be ruled out.
And I understand that you may not buy right now till the dust settles, but whenever you do decide to go in, what's that shopping list looking like? Give us the top 4 or 5 stocks that you'd want to buy and own in this fall.
Sure. I think some of the retail NBFCs have become very attractive. If you look at stocks like Bajaj Finance, if you look at Mahindra Finance, if you look at another interesting stock that I like a lot, Repco Home Finance. So those are stocks that I will keep my eye on. If this crack another 10-15% from here, I think they will be at very, very attractive levels. I think they are in a far better shape than banks to be able to pass on the increased rates to the clientele, and hence that might be an interesting bet. The other opportunity might be, I think, in IT stocks. Even at these levels, I think IT is still reasonably valued, particularly mid-cap stocks. If you look at something like Mindtree, must be trading at around 9 to 10 times earnings. And I think this entire rupee depreciation actually helps these companies a lot more than what people are currently anticipating. So my 2 top bets would be retail NBFCs and IT right now.
And within IT, are you talking more from the point of view of mid-caps or the top 4 as well? All 4 companies have registered growth. So what's the pecking order for you within the large 4?
I don't know the pecking order, but 2 stocks that I like a lot currently, one is Infosys on the large cap side, and the second is Mindtree, as I said earlier. I think Infosys might have just turned around in the last quarter. If you see, I think it has underperformed TCS by a whopping margin, around maybe even around 100% or so in the last couple of years. And I think if they get their act right, which my personal take is they would under the leadership of Narayan Murthy, and hence a lot of catch-up needs to be done, which probably can happen over the next 6 months.
Nitin, leave us with your strategy going ahead. Given the kind of market we're in right now, what would be your advice to investors?
Yeah, from a trader's point of view, I would say that you should play for a bounce right now. And ideally, if you can use options, I think that will be an interesting way to do it, because your losses on the downside will be limited. The volatility is just too much to be taking large positions in futures and all. So I would suggest maybe you can buy something like a 5850 call and sell maybe 5950 or 6000 calls. So that kind of a ratio spread might not be a bad idea. But keep a watch out, keep a lookout. I think over the next 3 to 6 months, you will get tremendous opportunities to buy some very high quality stocks. Even some of these banks which I've been saying don't look in good shape. I think once they start trading anywhere between 1.25 to 1.5 times book, which I do think you will get to see, then you must stick your neck out and take positions in these stocks.
All right, Nitin, thanks so much for joining us today. Markets are ending more or less flat. Surabhi, how's it looking in the heat map?
Flat, yes, but what a ride it's